Hi, I'm Jim Griffin, Investment Content Manager at Columbia Threadneedle Investments, and welcome to another episode of Credit Thread, a special fixed income focused podcast from the Eye of the Needle team. Credit Threads takes a regular look at macroeconomics, central banks, inflation, and their impacts on credit markets. And joining me for this episode are Gene Tannuzzo, Global Head of Fixed Income at Columbia Threadneedle, Alasdair Ross, Head of European Fixed Income, and Brian Lavin, Head of High Yield. I'm also joined by my co-host, Chris Morton, Fixed Income Client Portfolio Manager. Welcome all.
Hi, Jim.
Hello.
So, Chris, it's early March, and to be blunt, fixed income has had a pretty dreadful start to the year, with negative returns across regions and sectors. Central banks have been clear that they will be reducing their pandemic-driven accommodative stance and raising rates over the course of 2022. And very sadly, of course, we have the added stress created by the Russian invasion of Ukraine. Is all this what's driving markets, essentially?
Jim, that's exactly what we intend to dive into today. You're right. Returns have been dreadful across the board. And what's been extraordinary is not only the pace at which things got ugly, but that there's been nowhere to hide. Whether you've been short or intermediate or long duration, whether you've been in high or low quality, whether you've been domestic or globally focused, you've probably lost money. This dynamic is actually very atypical for the fixed income market, and Gene has recently referred to the current environment as a correlation tantrum. So let's start there, Gene. Why is nothing working?
Yeah, that's right, Chris. And I think to understand why the market is behaving the way that it is now, we have to think back to the response and the nature of that response to the pandemic from central banks. In 2020, we saw a massive amount of stimulus in the form of asset purchases and historically low interest rates from the likes of the Fed, the ECB, and the Bank of England. And if you look back to the summer of 2020, the Fed itself was projecting that it would not be raising short-term interest rates off of the zero lower bound until 2023 at the earliest. And what we're seeing now is really what can only be described historically as a V-shaped economic recovery, where in most locations globally, we've seen growth rebound pretty violently, quite frankly. So now the market has adjusted over the past 3 to 6 months and has pulled forward the timing when it believes the Fed will increase interest rates. And if we look at what is priced into the market now, we actually see a pretty steady progressive path of rate hikes priced in throughout the course of 2022. So that adjustment period is important. It's changed valuations, but it's painful in the immediate impact on market returns. And that's created an unusual environment where credit spreads have widened or corporate bonds have gotten cheaper at the same time that risk-free interest rates have gone higher. That's typically not the case. We typically look at treasury yields or core government bond yields as good diversifiers to corporate credit risk or even equity risk. But in this short period of time, it just hasn't behaved that way.
And as it pertains to Russia's attack on Ukraine, Fed Chair Powell recently said the implications of the U.S. economy are highly uncertain, and we will be monitoring the situation closely. How do you interpret that as it relates to the Fed and other CBs around the globe potentially changing course?
Yeah, there are two things, I think. One is the direct impact, and the other is the indirect impact. The direct impact comes through, in many cases, supply chains, and in this case, particularly commodities. So energy and some agricultural commodities that Russia and Ukraine supply will be directly impacted. We've seen that, and that's a particularly large share of the consumption basket in Europe, and also meaningful as we look at places like the US. So the inflation impact is real. However, as we think about central banks are really trying to control or influence financial conditions. Financial conditions are essentially something we've talked about on this podcast before, Chris, and really refer to access to capital, asset prices, and animal spirits. And as those conditions get tighter, it's harder for and less likely for companies and consumers to borrow money and spend money in an economically productive way. These conditions that we see geopolitically in Russia and Ukraine are influencing financial conditions, making them tighter, making asset prices lower, and quite frankly, will do some of the tightening for central banks. So even though the immediate impact is higher inflation, it may actually cause central banks, particularly the ECB, to take a slightly easier stance than we would otherwise expect.
Are you finding that the current macro environment is having a more outsized effect on certain sectors of the market versus others?
That's certainly the case. And emerging market debt, as you might expect, where Russia and Ukraine are involved, is seeing the most volatility. But we're also seeing tremendous volatility in government bond markets, more than we've seen in a long time. And I think that's important because, really there's a core scenario here that I think if we can get to a place where there is some positive resolution to the geopolitical concerns, where we would have, central banks gradually raising rates to sort of risk manage the inflation environment. But there are scenarios on either side of that risk management case that I think are worth exploring. One is the sort of concerning case around growth. Perhaps Russia or another catalyst causes growth to slow more than anticipated. That would certainly cause central banks to withhold their tightening and keep interest rates low. But there's also the flip side, which is a scenario we consider sort of hammer time, where the economic situation is firm, inflation remains high and hotter than expected, and central banks really need to increase rates more than we've seen in the past few cycles to bring inflation expectations down. I think that sort of wide range of scenarios on government bond markets is creating a tremendous amount of volatility there as well. So the volatility really ranges from the riskiest assets to the safest assets. And for us, we're trying to sort of navigate that into areas that are more insulated. Nothing's fully insulated, but I think corporate credit that we're going to talk about today is really a place where better opportunities lie.
Yeah, I do want to focus a little bit more on corporate credit now and dig into where some opportunities may have emerged through the volatility even prior to the Russia-Ukraine crisis. In previous podcasts, we focused a little bit on the consumer and the strength of the consumer balance sheet throughout COVID, but we do want to focus now on the corporate balance sheet. And as a multi-sector portfolio manager, Gene, I'm wondering if you are more constructive on corporate credit, either investment grade or high yield or both, now that spreads are wider, or are you still yet waiting for a better entry point?
It's a great question. The answer is on the margin, yes, we are more constructive. I think a better price is one element. Valuations are certainly a core element in addition to the technical environment and fundamentals. If we look at fundamentals, and you'll hear it from Ali and from Brian today, we feel pretty good about where large corporations are in terms of their balance sheet strength and their cash flow generation potential. So, the combination of cheaper valuations and a solid fundamental underpinning really do make us a bit more constructive at this point.
Great. So let's dive in. Ali, I want to start with you. When spreads widen or the environment gets riskier, investors might lean into more of a beta play, like an indexed ETF, for example. It's cheap and it's a way to grab some potential for spread tightening in investment grade or high yield. How are you thinking about overall global investment grade risk today? Is value pretty well distributed across the board, or is it more of a discrete alpha play?
Yeah, thanks, Chris. Yeah, I think Gene's right. The combination of rate moves and the pricing of central bank tightening we've seen, plus geopolitical risk premium going into the market, has meant the value we earn, or the extra income we earn from owning corporate bonds over government bonds, has become more attractive at the same time when corporate fundamentals are, pretty good. If you think about the investment grade asset class, we've seen 2 or 3 years of deleveraging in a row. As the pandemic came along, corporates reacted to that by cutting costs, husbanding cash. And then we've seen the growth in through 2021 and deleveraging of balance sheets, such that where we stand today, corporate fundamentals are better than they were back in 2019 or 2018. So the combination of that plus the improved valuations that Gene's touched on means that there is a broad opportunity to own corporate credit at this point. The sell-off, that we've seen this year has been pretty indiscriminate. So to that extent, you might say, okay, you can just kind of allocate to the market as a whole. However, corporate investment grade markets kind of offer opportunities, I'd say, through every point of the cycle. Where we are today, we've seen an indiscriminate sell-off. However, if you're going to allocate to corporates, why not kind of tilt that allocation towards sectors where fundamentals have actually improved? So, for instance, We know energy prices have continued to rise. Something that's kind of started, well over a year ago. It's been exacerbated by the current environment, but the fundamental outlook for these companies is actually, better than it was a year ago, and yet they've sold off almost as much as the rest of the market. And that's kind of something that's kind of quite common with credit sell-offs. You get the indiscriminate sell-off, and you may really, as a response, you should allocate to the part of the market that has sold off regardless of what the fundamentals is. So energy being a better outlook than it previously was. The other things that I'd say, to pick up one other point that Gene made about the kind of tail risks, if it's the case that we do have a growth slowdown. So at the moment, credit markets are not really concerned. In a way, the interesting thing has been how little the sell-off has been, considering these elevated risk factors. Credit markets are quite comfortable with taking earnings risk. And so, there's sectors in the credit market that are much more stable than others. Regulated earnings, regulated utilities, for instance, where again the sell-off in those sectors has been similar to the rest of the market. So we'd sort of always advocate trying to take advantage of the opportunities that credit markets offer. And at this point in the cycle, I'd say the likes of utilities and energy would be where we'd favor adding.
Are there any elevated risks on your radar, such as, shareholder-friendly activity on the part of CEOs and CFOs that you're mindful of?
Yeah, I mean, it's something we're looking at because, I'd say the credit market has expected companies to use cash flows to deleverage. And then that is actually what we've seen, right? So, to the extent that CEOs and CFOs stop doing that, if the kind of cash flows that were coming through with the associated improvement in earnings were stopped being used to deleverage balance sheets, I think that is something that the credit market would, slightly reprice for, because, continued deleveraging I actually think is expected. So we kind of watch for that through all the earnings seasons of every quarter. So far, we've kind of seen cash being used to deleverage, as well as earnings growth being used to deleverage. I think, in periods of elevated uncertainty, it's human nature that you're likely to kind of continue to de-risk your business if you can. And so, it's not a kind of theme that I'd say is concerning us, but I think it is something that the credit market, expects to continue.
And what about rising inflation? So far, would you say the trend has been that companies have been able to pretty much pass along those higher costs to the end customer, or does it really depend upon where they are on the chain? In other words, how close the company is to the end consumer?
Yeah, I mean, I think it's actually less about, whether you are close to the consumer, or you're a business to business. It depends on, the industry you're in, the product mix you've got, the market share, so your ability to have pricing power. So we've been surprised to say in aggregate, we've been, pleasantly surprised that companies or the market in aggregate has been able to, in the main, pass on increased costs. So we have had incidents and isolated incidents of kind of companies that, have seen margin compression, but they're the sort of exception rather than the rule. And I'd say it's more, but it is in, various different sectors. So I'd say it's less about the sectors or how close you are to the consumer, and it's more about your own pricing power, which is, as I say, a combination of your product mix, your industry environment, and your market share. Now, I guess for IG, one of the things about being IG is you typically do have good market share. If you're a small player in a very competitive industry, that's kind of not a typical investment grade type operational profile. So as an asset class, in the main, a lot of the IG companies that we're looking at, do have that ability to pass on costs. And actually, when when our analyst team kind of looks into 2022 and 2023, they see margin stability and actually, a little bit of margin improvement. So the isolated pockets are there, but it's actually been, in a way, surprisingly surprising that we haven't really seen bigger margin compression, considering the inflation backdrop and the labor market backdrop.
Terrific. Thank you, Ali. So let's shift to high yield. And Brian, when I look at returns, high yield has gone through a pretty significant repricing in response to a more hawkish Fed. The sector is down just around, maybe a little bit under 4% overall year to date. Would you say that high yield, the poor performance has been more across the board, sort of indiscriminate, as Ali had said, with investment grade, or have some industries and companies fared better than others?
Yeah, thanks, Chris. It's been broad brush. There are some nuances, and I'll touch on those a little bit. But as you point out, high yield is down about 4%. Double Bs are down over 4%. Single Bs around 3%, and double Bs have performed poorly for a couple of reasons. Mainly duration. They tend to be longer securities. They also started the year a little bit tighter than the rest of the sector, and so as the duration impact has really disproportionately hurt the double B space. Interestingly, in the triple C space, the triple Cs have performed negatively, down about 2.5% versus 4% for the market. But the message the market is giving us is that it's not necessarily default risk that is the problem. It's really more of a pricing in, a better pricing in of the geopolitical and the Fed risks that we're seeing in the marketplace. If triple Cs were to have widened significantly, that would have been the signal that the market is more worried about default risk, and that hasn't been the case.
Now, does the widening create in spreads generally, does it create opportunity, or do you think from here it could get materially worse? And I'm also interested in whether or not investors are hanging in there or whether you're seeing flow pressure in terms of investor activity.
Yeah, I would say much like agree with Ali. We came into 2022 with really strong fundamentals, mid-single digit revenue and cash flow growth projected, surpassing levels we saw in 2019, leverage coming down, again, getting to points that are better than 2019, defaults, which are a significant part of the high yield equation, less than 1% now and projected to continue to be less than 1%. Now, the events in Ukraine are significant, and what we've seen there are increased commodity price volatility, and those things are now better priced in. So in our view, the balance in the high yield equation right now is much better, and I think that the asset class is in a better position to kind of handle and better reflects the fundamentals that we see out there. You asked earlier about individual industries. I would say, much to Ali's point, commodity sectors have done better. That's the energy space and metals and mining. And then the sectors that have performed more poorly have been the longer and higher quality sectors like cable and utility.
Now, when investors look to tap into the below investment grade corporate space, they can invest in high yield bonds, or they can invest in the leveraged loan market. And in the current environment, it would seem that investors are largely choosing the leveraged loan or floating rate market, bank loans, all the same thing, because of the fear of rising rates. And the question people should really be asking themselves is, what do you think about the credit environment? But usually when people are buying bank loans, it's because they fear rising rates and the detrimental impact on pricing. Now, you're a portfolio manager that can invest in both segments of the market across your portfolios. How are you thinking about the leveraged loan or floating rate market relative to the high yield bond market?
Sure. It's a good question. And what we've seen now versus, say, the beginning of the year, at the beginning of the year, the leveraged loan valuations really were in a much better spot vis-a-vis high yield. But with a downturn in the market that we've seen in high yield, about 4%, leveraged loans only down about 0.5%. That dynamic is much more balanced. So then the question is, let's talk about the characteristics of the two asset classes to determine what makes most sense right now. And when you think about loans, there's been an increase in loan-only financings in our market, which means first lien and second lien. There's been an increase in M&A financing in the loan market. Now, loans generally have a much more favorable spot in the capital structure vis-a-vis high yield bonds. They're secured. And then regarding the interest rate component, one thing that needs to be discussed there is that there is such a thing in the loan market as LIBOR floors, which means that there is a rate in which the loan will never go below. Now, that's great, protecting you on the downside. On the upside, what you need now is an increase in LIBOR or short-term rates for another couple of quarters before that the benefit of the rising rate part of that will kick in. You mentioned flows. The flows have been much stronger in the loan space. Positive in 2021, positive again year to date, and high yield has been under pressure in 2021 and thus far year to date. It hasn't created disallocations in the market. The loan market has just felt a little bit stronger technically. So with the relative value case going forward, since high yield has repriced, we think both of the asset classes represent, good opportunity, good risk-adjusted return. And I would say if one had the view that the Fed was going to act more significantly than what's currently priced in and quicker, then you would skew towards loans.
That's great. Thanks, Brian. Gene, as we look to wrap up then, I'm going to put you on the spot, if you don't mind. Do you think the worst is behind us at this point, or is it in fact time to sell?
Yeah, thanks, Jim. Look, I think there is an attractive entry point here developing in the bond market. And I think, one of the things I like to think about is at the end of the day in fixed income, there are two ways you can lose money. You can have a company or an issuer default on its obligation, or as an investor, you could sell after interest rates have risen. And I think what we're seeing now in the marketplace is more of the latter. You heard Brian and Ali talk about fundamentals are actually quite strong. Defaults are actually quite low. So I think it's really an opportunity now that we've had a repricing in valuations for investors to maybe rebalance their portfolios. And if we look back to 18 months ago, really August of 2020, when 10-year Treasury yields were at their lows of 0.5%, if we would have sat down at that time and said, hey, a year and a half forward, the S&P 500 will be 65% higher and 10-year Treasury yields will have quadrupled, what would you do about it? And I think most investors would say, with a level head, well, that would be a good rebalancing opportunity to add bonds back into a portfolio. What you've just heard is that we do have an additional risk premium now in the price for central banks tightening. We do have a risk premium in the price, perhaps for some geopolitical concerns, and you're paid a little bit more for what we still think are good fundamentals. So short answer is yes, I think it's a good opportunity to add some fixed income exposure.
That's very interesting. Thanks, Gene. So that's all we've got time for this episode. Gene, Ali, Brian and Chris, thank you very much for helping out on this episode of Credit Threads. It's been very interesting and it's really helped put the recent fixed income performance into context and hopefully will give listeners some real food for thought. We'll be back next month with another look at macroeconomics, central banks, inflation and their impacts on credit markets. We'll see you next time. Thanks again.
Important information. This is an advertisement. This podcast is intended for informational purposes only and should not be considered representative of any particular investment. This should not be considered an offer or solicitation to buy or sell any securities or other financial instruments, or to provide investment advice or services. Investing involves risk, including the risk of loss of principal. Your capital is at risk. Market risk may affect a single issuer, sector of the economy, industry, or the market as a whole. The views expressed are as of the date given, may change as market or other conditions change, and may differ from views expressed by other Columbia Threadneedle Investments associates or affiliates. This information is not intended to provide investment advice and does not take into consideration individual investor circumstances. Investment decisions should always be made based on an investor's specific financial needs, objectives, goals, time horizon, and risk tolerance. Asset classes described may not be suitable for all investors. Past performance does not guarantee future results, and no forecast should be considered a guarantee either. Information and opinions provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed. This podcast has not been reviewed by any regulatory authority. In the USA, Columbia Management Investment Advisors, LLC, CMIA, is an investment advisor registered with the US Securities and Exchange Commission. In Australia, issued by Threadneedle Investments Singapore Pte. Limited, TIS. ARBN number 600-027-414. TIS is exempt from the requirement to hold an Australian financial services licence under the Corporations Act and relies on Class Order 03/1102 in marketing and providing financial services to Australian wholesale clients as defined in Section 761G of the Corporations Act 2001. TIS is regulated in Singapore. Registration number 2011015559W by the Monetary Authority of Singapore under the Securities and Futures Act, Chapter 289, which differ from Australian laws. In Singapore, issued by Threadneedle Investments Singapore Pte. Limited, 3 Killiney Road, 07-07, Winsland House, 1, Singapore 239519, which is regulated in Singapore by the Monetary Authority of Singapore under the Securities and Futures Act, Chapter 289. Registration number 2011015559W. This advertisement has not been reviewed by the Monetary Authority of Singapore. In Hong Kong, issued by Threadneedle Portfolio Services Hong Kong Limited, Unit 3004, 2 Exchange Square, 8 Connaught Place, Hong Kong, which is licensed by the Securities and Futures Commission, the SFC, to conduct Type 1 regulated activities, CE AQA 779, registered in Hong Kong under the Companies Ordinance, Chapter 622, number 1173058. In the USA, Columbia Management Investment Advisors, LLC, CMIA, is an investment advisor registered with the US Securities and Exchange Commission. In the UK, issued by Threadneedle Asset Management Limited, registered in England and Wales, registered number 573204, Cannon Place, 78 Cannon Street, London, EC4N 6AG, United Kingdom. Authorised and regulated in the UK by the Financial Conduct Authority. In the EEA, issued by Threadneedle Management Luxembourg, SA, registered with the Registre de Commerce et de Société Luxembourg, registered number B110242, 44 Rue de la Vallée, L-2661, Luxembourg, Grand Duchy of Luxembourg. For investors in the Middle East, this podcast is distributed by Columbia Threadneedle Investments, ME Limited, which is regulated by the Dubai Financial Services Authority, the DFSA. The information in this podcast is not intended as financial advice and is only intended for persons with appropriate investment knowledge who meet the regulatory criteria to be classified as a professional client or market counterparty, and no other person should act upon it. Columbia Threadneedle Investments is the global brand name of the Columbia and Threadneedle Group of companies, columbiathreadneedle.com.